Hello, everybody. This is Toni Turner, and welcome to the market now as of Friday, May 29th at about 12:30 p.m. Eastern. Well, Wall Street's main indexes are falling so far today as investors are on edge ahead of a U.S. response to China's national security law on Hong Kong that threatens to take the shine off another month of strong gains for the stock market. Despite worsening relations between the world's two largest economies, expectations of a quick post-pandemic economic recovery have driven the S&P 500 about 37% higher from its March lows as it heads for its second straight month of gains. So let's hope that keeps on happening. First of all, as we always do, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. Of course, this is the exchange-traded fund that closely follows our benchmark S&P 500 index. Now, when I captured this chart today, the SPY was trading at $300.94, or just above the 3,000 mark on the S&P 500 itself. Now, since the all-time closing high at $338.34, or about $33.83 on the S&P 500 itself, the SPY is now 11% off of its highs. And if it were 9% off of its highs, it wouldn't be in correction territory. What we call correction territory is always when an asset, in this case the S&P 500, is more than 10% off its highs. So it's 11%. It's done a really good job of coming off these March lows. Now, the March lows were down here at 218 on the SPY, or about 2180 on the S&P 500 index. As I said a moment ago, the SPY has risen now back up about 37%. So it's done a fantastic job. Also, as you can see, it's jumped above the black line on my screen. That line is the 200-day moving average. That can be a tough dude to get over, and the SPY has penetrated that, has moved up. I always like to see 3 consecutive closes above that line if whatever I'm looking at is going to stay above that line. We're cutting it close today, though, again, with the SPY at the moment trading at $300.94. So right below it here is the 20-day moving average, the red line. That's coming in now at 291.48. So if the SPY starts down, that could, is the operative word, prove to give it some support. Of course, then we have this gap down here. If that gets filled, the SPY could head down lower, close to about 275 or 2750 on the S&P 500 itself. So we're watching 280 here, or 2800. We're watching that as potential support. Then down here where the 50-day moving average is coming in at about the green line at about 276.58, and then down at watching 270 pretty closely. So we'll have to see here. Now we do have, if we were to put, I'm not drawing it too straight, am I? If I could put trend line, draw a trend line up here, we know it was much steeper before. Coming into April, it started losing some of its giddy up, but that was a real fast V-shaped recovery off of its lows for sure for the SPY. Into April, as I said, started calming down a little, dropped hard on May 14th, but then rallied right back up. Buyers came in immediately. That was a good thing, very bullish, and then it's continued to climb into this week. However, as you can see, volume is slowing down a little bit here at the moment. The RSI, the 14-day RSI, is kind of bumping its head up against this overbought line. And we can see the tech stocks, the growth stocks, taking a little rest here. They were up again today, but taking a little rest in the last couple of days. So this may be an area not of fear, certainly, but an area of concern that we're coming into here. We could see a little bit of a rising wedge starting to take place here. So I, for one, will become a little more cautious here. This has been a lot of fun. However, I'm not I'm not willing to give my profits back. So we'll just have to see here in the next few days, especially with its announcement coming in about China tonight. Okay, so let's go on to our next chart. Our next chart is a daily chart of the QQQ, the Invesco QQQ. As you all know, this is the major index in the market that is led by some of our top growth stocks. So, of course, that would be the FANG stocks, Facebook, Alphabet, Amazon, Google or Alphabet, as I said, Netflix, Microsoft, Intel. That whole group leads the QQQ higher. And as you can see, tech stocks have had one fantastic rally ever since they hit, or it hit the lows down here in March. Now, the all-time closing high was back here in February at $236.96. Now today, when I captured this chart, trading at $229.73, just about 3% off that high. So definitely out of correction territory and looking like it's really trying to make its way back up to that all-time high at about 237. So that will remain as resistance, 237. We'll have to see how far the Qs can go. We have support down here at 230, right where it's sitting. And we have this uptrend going on here that you can see a very nice uptrend I've drawn here with the blue line. Now last week we talked about, let me see if I can redraw it. We talked about the possibility here of a rising wedge coming in. Rising wedges, of course it means the stock's in an uptrend. Of course, when stocks are in uptrends and there is, or assets I should say, like the QQQ, this index, it was a really tight, strong, almost parabolic move at first. Then the trend starts what I call softening a little bit as the lows aren't lower, but they start coming down percentage-wise a little lower than the last low before it. So now we have this blue line. Actually, the 20-day moving average is doing a great job of drawing a trend line for us. But these highs here are not moving up in line with what would be the parallel here. The highs here are drifting down a bit with every new one being made. So what could happen here is obviously stocks go up, down, and sideways. It could certainly move higher here. I would imagine it's going to hit a little resistance here at the 237 mark. We could see the Qs for now move into a consolidation zone. That wouldn't surprise me at all. Hopefully stay above the 20-day moving average, which is coming in now at $224.40. That's the red line on my screen. If they need to take more of a break than that, then we can see the 50-day moving average. And of course, the moving average moves every day depending on where the close is of the asset you're trading. So at the moment, the 50-day moving average is coming in at about 209. Of course, that will change with every day's price action. But we can see there's quite a bit of price support as well on the QQQ. And so a lot going on here, but I would definitely get a little cautious. We could see value stocks start to come into their own, start to move higher in this past week. Doesn't mean they'll continue to do it, but usually when tech stocks, or I should say big momentum growth stocks, move high dramatically, that's because buyers want to be in those stocks. They're fun, they're exciting, they move up big time when they move, and that's totally understandable. But then when we get a little more defensive, typically we move back down into what we call value stocks that pay higher dividends and are quite a bit more conservative. They're not as exciting, that's for sure. And in fact, because of the movement I see in the Qs here today, it's all good, but I would like to be a little more conservative in the coming week, a little more defensive. We'll take a look at our final chart for the day. Our final chart for the day is the Invesco Wilder Hill Clean Energy ETF. The PBW is the symbol. Now you can say, what happened to this guy after all we've just looked at? The Invesco Wilder Hill Clean Energy ETF, PBW, it has 40 holdings. Some of the top holdings are Enphase Energy, Tesla, NEO Incorporated, Vivint Solar, and Bloom Energy. Now, to give you some perspective, when I captured this chart today, the PBW was trading at $34.46. It made an all-time high in December of 2007 at $144.20. So clean energy has not gotten a bad rap at all, but it's certainly been very, very calm. And if you go and look at a monthly chart or even a weekly chart of the PBW on your own software, you'll see what I mean. Back in 2007, which of course is not on this chart, the PBW was way up at $144. Since then, it's fallen dramatically, and on a monthly chart, it looks just like it's flatlined until recently. Recently, more volumes come into it. Recently, and as you can see, in January and February of this year, it climbed up to a relative high of back up here in about, let me see if I wrote that high down where it came up to, 45. So it came up to a recent 45 this year in February. Then it fell dramatically down to $22.20. That was a really big fall, about a 50% move down. Then it started coming up, not a big flashy move like a lot of the other ETFs, but it did start coming up gradually. So this is, as you can see, a much more conservative play here. This is not something you want to day trade or get in it, probably not want to get in it for 3 days or something. I would look at this as a little longer term if it behaves, Now, again, as I captured this chart today, the PBW was trading at $34.46. Now, if the SPY and the QQ decide to trade horizontally next week, or if they decide to even back off a little bit, backpedal a bit, the PBW may be a good place to hang out. Now, if it can remain above 33, now look where the 20-day moving average is coming in here at 32.47. I want, for my lips, I want the PBW to stay above $33 and continue this uptrend. Now, you can see when it pulled back on March 14th, it did make a real quick lower low here, but it jumped right back up. And jumped right back up and continued moving higher. So it is in a little uptrend here. It's up 55% off of its all-time lows, but it's doing so very gently. It's not making a parabolic move, so it looks pretty good and defensive to me. If it can remain above 33, so that even gives it room to pull back here. If it can remain above 33 in the coming week, I may add a small position of the PBW to my portfolio. I will place my initial stop pretty tight at at 32.40. My initial stop at 32.40. And if in coming weeks the PBW can climb above 36, I may add some shares to my position. Now, if you look over here to the left with me, back in February, early March, the PBW had fell in a gap down here. Now, if that gap is to be filled, if it moves over 36, then the low here, the close is a little bit above it, is at about 37.38. So I may add, see if it can move its way up and then fill that gap. So that's kind of what I'm thinking of. Of course, if it starts moving up, I'll move my stop into a trailing stop. And if it starts faltering up here, I might even take a few shares off or add to my position. It's hard to say until we get there, but this is not an extremely volatile ETF, so I will make plans when it gets there. And of course, as always, because of the market we're in especially, please know that if the market rolls to the downside abruptly, I may exit the trade early and before it reaches my stop. So with all that said, you may, if we get defensive next week, you may want to keep an eye on the PBW. And now, before going into the question this week, our kind of behavioral psychology question, Please know that if you are interested in boosting your trading profits, you may want to check out my online training products. Just go to the link on this screen or click on the button you can see below. Okay, so as you approach the market in the coming week, you may want to ask yourself, when I'm trading, do I ever find myself in a mental battle between market momentum and my need to think independently? The battle between market momentum and your need to think independently are very, very important to think about. Now, it happens to all of us at one time or another. We pick a good stock, we plan our trade, we enter at the price appropriate to our plan, and then whack. The market shifts or reverses on us. Herd mentality rules and takes the market and our stock in the total opposite direction of our trade. So it started out to be a great pick and a good entry, totally dissolves on us. Now the battle starts between them and us. Now, maybe you white-knuckle the trade, believing so strongly in the stock that you got into that you refuse to think it will stay down for long. This is a great example of a good idea to enter a trade, but the overall market timing turned out to be wrong. I mean, that's it. And you didn't know that. Was it your fault? No. But what we could call wrong are the times that we ignore our protective stops and lock down on losing trades. Please remember this. Please, please, please remember this. Emotions move stock prices in the short term. Fundamentals move prices in the long term. And you could even say, well, Toni, I got in because the fundamentals were so good. And that's fine. But the short term could last for the next 3 weeks or even a month. So do you want to take that chance? We cannot, as individuals, decide the daily route that the stock market will take. The market shifts momentum and moves into reversals, again, according to herd mentality. We need to remember to go with the flow and stay with the trend. As the famous economist and speculator John Maynard Keynes once said, the market can remain irrational longer than you can remain solvent. And I try to never forget that. So when the market turns against us, we need to respond wisely, manage risk, mind our stops, and focus on protecting our capital at all times. So on that note, until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.